Hi guys and welcome back to the channel. This month's video I've got 3 UK stocks lined up which I think look like good buys with sound long term fundamentals. If you enjoy this video and insight into these companies, please drop the video a like and subscribe to the channel. Stock number 1 is a company called Croda, who are one of the world's leading producers of specialty chemicals. The vast majority of their sales are within the healthcare and beauty industries, where their products on offer are lipids and surfactants, oils with high concentrations of omega-3, essential fatty acids, protein derivatives, as well as within cosmetics, household cleaning products, crop protection products and water treatment products. They also provide industrial specialty products used within the plastics and rubber industries. Sales are global, with almost half of their revenue coming from Europe, the Middle East and Africa. Looking back to the early 1990s, by holding this stock for 30 years, you'd be holding a company which is up over 3,000% from where it was listed on the stock market originally. Over the last 5 years, it still gave fantastic returns, which would have given you a gain of over 75%. And if we look at this year alone, we can see that the stock has really struggled and down almost 25%, which gives it a market cap of 9.7 billion, a PE ratio of 13.6 and a reasonable dividend on offer at 1.5%. And if you're a technical trader or investor, you can present the case of a possible reverse head and shoulders pattern here. This pattern can be the beginning of a move to the upside, but nothing is ever certain within the stock market. Croda's recent results were really impressive as profits soared in the first half of the year. Croda said interim pre-tax profits were up 211% at 636.5 million. Operating profits were 32.1% higher at 288.6 million, and basic earnings per share were at £3.89, driven by a 20.7% increase in revenues to 1.12 billion. Margins expanded from 24.6% to 26.6% in its consumer care division, while margins grew just under 3% in its performance technologies wing, but slipped more than the 3 percentage points in its life sciences unit, coming in at 18.3% and 36% respectively. Croda added that it now expects full year adjusted pre-tax profits to be modestly ahead of previous expectations, with growth in the second half projected to moderate in the consumer markets, together with lower sales in lipid systems and the reduced COVID vaccine demand. The improved full year outlook reflects the enhanced strength and breadth of Croda's portfolio, including a more resilient consumer care growth platform, strong ongoing demand in crop care, albeit against a tougher second half comparator, and healthcare enjoying good growth overall. Growth beyond 2022 is further supported by a strong innovation pipeline, notably in non-COVID healthcare applications, and our targeted capital investment programme. Over the past 4 years, revenue has been pretty resilient, with earnings struggling during 2020. However, a strong recovery in 2021 is reflected by strong revenue and earnings growth. Using simply Wall Street, they have revenue over the next few years normalising before returning to growth, but they expect that free cash flow and cash from operations should be continually improving out to 2025. Simply Wall Street screening shows that Croda's financial health passes all 6 checks. Assets, both short and long term, outweigh liabilities, which is pleasing to see. With only one red flag appearing due to debt, the debt levels are 1 billion, but when you consider that they have over 750 million in cash, I wouldn't say that this is a cause for concern. Croda does offer a respectable dividend, which has been a little volatile in recent years, but it has been growing since 2019. The next ex-dividend date will be the 8th of September to collect a dividend of 47p per share in October, and as with most UK companies, Croda pay out their dividends twice a year. Over the last 18 months, sales growth across all areas has been strong, more notably within Asia and Latin America, where reported sales have grown more than 30%. Now on to some of their revenue streams and what the future growth drivers can be. Within their consumer care business, they have products across beauty actives, beauty care, fragrances and home care, which are all areas that will be around for a long time to come. The life sciences portfolio offers healthcare and crop care, which we know for healthcare and an ageing population will have growing demand alongside crop care, which may become more important over time due to global warming. Providing sustainable ingredients out to other companies such as Unilever and the others shown here helps with the move to use more sustainable materials and shift from traditional fossil fuels. With this theme becoming ever more important to companies and consumers, I see this as a good area to be doing business within. Croda also has strong growth drivers through their biopharma segment of the business, which assists in a lot of today's illnesses from cancer and helping prevent respiratory disease and providing therapeutic vaccines. Lastly, on the biopharma side of things, Croda have a phase 3 trial in the US which offers an alternative to traditional injections, with a phase 2 trial being carried out in Denmark to assist in cancer therapy, and finally Croda are looking into gene therapy, which at the moment is something that seems miles away, but over the next 10 years or so it should become a more readily available type of treatment. Tip ranks have 7 analysts on Croda, with an overall moderate buy rating. 4 have it as a buy, 2 hold and 1 sell, which would give it an average price target of 8,200 pence, or nearly 20% from current prices. Stock number 2 is a company called Halma. Halma specialise in the design, manufacturing and marketing of security equipment. Their products vary from infrastructure surveillance sensors and industrial equipment, which includes fire and smoke alarm detectors, electronic elevator systems, flammable and hazardous gas detection systems. They also have products to help environmentally, such as water storage and water treatment, and finally also provide healthcare equipment. Really diversified company in terms of what industries they work within and also geographically. Chances are if you've bought this and held Pharma for the last 30 years, then you won't be watching this video, but instead probably living the high life, as this would have given you a whopping return of over 88,000%, which is absolutely bonkers. More recent history, over the last 5 years, you're still up 95%, but as with most of the market, it's down nearly 30% this year, and just like Croda, it also presents the case of a reverse head and shoulders pattern unfolding. Right now Halma has a market cap of 8 billion, a rich PE ratio of 32, and it offers a dividend of 0.89%. The last 4 years, earnings have been resilient and even growing, and that's through the pandemic, which shows how durable this company can be during tough times. Simply Wall Street has Halma continuing to grow in all areas financially out to 2025, where revenue is expected to be close to 2 billion. All 6 financial health check categories pass the screener here, with both short and long term assets covering liabilities, which again is always good to see. With the only red flag showing the same as the last company, and this is the debt, which is around 360 million, but again nothing that I would say is any cause for concern. Halma reported a rise in adjusted annual profits after a surge in revenues, and it said that Chief Executive Andrew Williams had decided to retire after 18 years in the role. The company posted an adjusted pre-tax profit of 316 million, up 14%, as revenues rose 16% to pass 1.5 billion for the first time. Williams, who will be succeeded by Chief Financial Officer Mark Ronchetti, said that the company made a positive start to the new financial year, with a strong order book, and order intake in the year to date is ahead of revenue and in line with the very strong intake in the same period the previous year. He said that Halma expected to deliver continued growth, maintain high returns in the current year, with good single-digit percentage organic constant currency revenue growth and a return on sales similar to the second half of 2021-22 financial year. Halma offers a small but growing dividend, as it has increased from 14.68 pence in 2018 to this year. It offers a payment of 18.88 pence per share, which has been split into an interim payment in February and a final payment in September. I've added this in, and it's an extract from the results, and it shows you over the last 10 years Halma has outperformed all indices such as the Nasdaq and FTSE 100. With a rich PE ratio, you could argue that this company is overvalued, or does its strength and resilience warrant the premium price? And that's what we need to try and work out as investors, but nonetheless, historically Halma has been a great addition to any portfolio over the last 10 years. TipRanks has 7 analysts covering this stock, giving it a current hold rating, 2 rate it a buy, 4 hold and 1 sell, and this gives it an average price target of 2,359 pence, or 11% upside from current levels. And finally, stock number 3 is Airtel Africa, who specialise in the provision of mobile telecommunication services. They operate by providing mobile services, internet access and data transmission services, as well as having a small portion of their business offering mobile money services. Airtel Africa hasn't been listed on the London Stock Exchange for a long time, and we can only go back to 2019, where we can see that over the last 3 to 4 year period, you'd still be sitting on a gain of very near 100%. Even if we look at the last year, this chart is the polar opposite to the general market, and it's risen 45% this year alone. Currently, Airtel Africa has a market cap of over 5 billion, a PE ratio of 9 and a 3% dividend on offer. The share price performance mirrors how the business has been performing in recent years, with continuous year-on-year improvements in both top and bottom lines. Analysts expect this to be a continuous theme out to 2025, where revenue could be closing in on $6.5 billion. Unlike the last 2 stocks, we do have 2 sections of financials where the health screener has flagged up here due to regards to both short and long term liabilities. When we look into this, it looks like the software has used the balance of short term assets of 2 billion, which doesn't cover the short term liabilities of 3.1 billion, but long term assets of 8.2 billion do cover the long term liabilities. And again, this gets flagged up as on the debt side, with $2.3 billion in debt on the balance sheet. Telecommunication companies do tend to carry larger amounts of debt to help allow build out their infrastructure, or sometimes when they look to carry out acquisitions. First quarter revenues had grown double digits amid margin and earnings progression and a further strengthening of its balance sheet. Airtel Africa posted a 13% increase in reported currency revenues to $1.25 billion. Revenue improved in constant currency across all four of the group's reporting segments, with mobile services revenue up 14.2%, voice revenue up 11.3%, data revenue up 19.8%, and mobile money revenue 26.5% higher. As a result, operating profits increased 20.6% to $425 million. Profits after tax improved 25.3% to $178 million. Underlying earnings grew 14.9% in reported currency to $614 million, and EBITDA margins expanded 78 basis points in reported currency terms to 48.8%. Basic earnings per share increased 31% to 4.4 cents. Airtel added that operating free cash flow grew 10.3% to $473 million, while net cash generated from operating activities reduced by 13.2% to $388 million, principally due to increased cash tax payments from both higher taxes on declared dividends and increased taxable profits. However, Airtel also cautioned that it faced headwinds from outbound voice call barring from customers who had not yet registered their national identification numbers in Nigeria, and a loss of site share revenue in those OpCos where it recently sold towers. Inflation is also having an impact on our cost basis, particularly on the energy costs, but our continued efficiency drives have ensured that we've still been able to increase our margins, albeit at a slightly lower rate. As the share price has performed well, this does make the start yield a little less attractive than where it has been. The dividend payment has fluctuated slightly between 4 and 6 cents, with two payments each year, one in July and the other in December. Africa has bags of potential for growth over the coming decade as they migrate over to 4 and 5G networks. Mobile customers from 2019 to 2025 is due to grow at a combined annual growth rate of 4.3%. Mobile internet users is due to grow at a combined annual growth rate of 9.7%, which we still only have a penetration rate of 39%. Tipbanks only has one analyst covering this company, and they have it with a buy rating with an average price target of £1.90, which would give a whopping 40% increase from current levels. And guys, this will bring us on to the end of this month's picks. I hope you enjoyed the overview into these companies, and I'll catch you all in the next video. Cheers.